Hello, my name is Paul Stevens, editor of Short Term Rentals, and welcome to this latest webinar in our Urban Living series, this time on Flex Rentals, Investing in Innovation. We'll now move on to the presentation of what you can expect over the next hour. Please keep your microphone and camera off for the duration unless you're a speaker. This is a precursor to the inaugural Urban Living Festival, organised by International Hospitality Media at Tobacco Dock in London on the 25th to 26th of November. It should be a really good, exciting event for the hospitality and real estate sector, so we're really looking forward to it. Thank you, Justin. In terms of webinar guidelines, please keep your sounds on mute if you're not speaking. The discussion should take around 45 minutes to complete, with hopefully time to have a short Q&A for some of the questions that you're sending in afterwards. I should also say that I'm being ably assisted by my colleagues, Joe and Justin, behind the scenes, so please do refer to them, and all of the details are in the chat if you'd like to send a question or any links that are being provided throughout. This is me, Paul Stevens. Nice to meet all of you. I am the editor of Short Term Rentals, part of the IHM portfolio. We're the leading B2B website for short-term rentals around the world. And I'm also one of the hosts and the head judge of the Shorties Short-Term Rental Awards, which we launched earlier this year. So let's begin by welcoming our panel, and I'd like Mickey Kropf from Vector Travel to begin.
Thank you, Paul. Thanks for having us. Yeah, I'm Mickey Kropf, the co-founder and CEO of Vector Travel. We're a multifamily or an apartment industry hospitality company, and so we partner with real estate companies to activate their vacant spaces through short-term rentals and mid-term rentals, and we do that through a revenue share platform. So tech-enabled operator, active in about 25 markets in the US.
Thank you very much, Mickey. And Michael, take it away. Michael, you're on mute.
Thank you. I was just saying, Paul, thank you very much for putting together this panel. My name is Michael Chang. I'm a partner at BV Real Estate Partners. We are a investment firm based in New York City. Our business is divided into two sections. One is we invest in early stage companies, particularly on the property technology side. We are investors in a number of short-term rental companies. We also own and operate a portfolio of short-term rentals and vacation rental properties in Philadelphia. My background, quickly, former investment banker at Merrill Lynch and Jefferies for the last 10 years before starting the firm with a number of partners 2 years ago. So nice to meet everyone.
Cheers, Michael. We'll try not to get you and Mickey confused throughout this webinar. And Steve, please take it away.
Hi, I'm Steve Lowy. I'm CEO of Anglo Educational Services. We operate 200 apartments mainly aimed at students, actually US study abroad students across central London in 10 blocks. And we also have a luxury brand called The Residence, which is more for corporate relocation and more luxury stays, more luxury level. We have 61 apartments of those across 4 locations. My background is actually, I've run hostels, run my own budget hotel chain, and obviously now in the service apartment space, and set up a digital marketing agency for hotels 10 years ago. So I understand a bit of the tech side of things.
Excellent, thank you very much, Steve. And last but not least, Susan.
Thank you for having us, Paul. We love this space. I'm with Cushman and Wakefield. My team specializes in what we call synthetic affordability driven by technology and operating systems. So we very much like the short-term rental or flexible space, both in terms of nightly stays as well as extended stays.
Excellent. So we've got a little context page just to introduce you to the topic. So we have pre-COVID and we have post-COVID. Last year, I was at the Flex Rentals Investment Conference in San Francisco, and we were looking at the adoption of short-term rentals, particularly in the multifamily space. So, Mickey, you'll know about this. And I thought this quote from Luke Bajarski's Luft article was really relevant for the discussion, talking about how there is huge demand for innovation in real estate at the moment. And city leaders now have an opportunity and responsibility to take the lead in fostering innovation within the real estate industry. Moving on to post-COVID, lots of things happening with the various hospitality startups. On one hand, we've had a brand such as Sonder raising $170 million in a series. In a Series E round back in June. And on the other hand, we've had worse news with the likes of Lyric and Stay Alfred having to close their operations or retreat significantly. So that just gives you a bit of a taster of what we're going to be talking about today over the next hour, 45 minutes. But yeah, my first question really centers around how do we actually define what a flex rental is? I think we'll all agree that there are various different silos and different types of understandings of what this actually includes. But Mickey, I mean, we met at the Flex Rental Investment Conference last year. It was a pleasure to meet you. How do you think the flex rental landscape has changed?
Yeah, it's changed drastically, right? I mean, you just mentioned two of the marquee players. I mean, Stay Alfred, I have nothing but respect for what they did. They were the trailblazers within multifamily hospitality, in my opinion. They sort of championed that master lease model, which was then copied by Flatbook, which became Sonder, Parallel Travel, which became Lyric, and all kinds of capital poured into these companies. And unfortunately, pandemic, but there's other things there too. There's timing of fundraising. There's maybe, valuing speed over efficiency, or in other words, unit economics, in doing what is ultimately a real estate, a prop tech company. It's not a pure software play. So I think that weakness of that model was exposed, and I have a background in running that sort of model too. I ran a rental arbitrage fund before around long-term leases to short-term rents, and we learned pretty quickly. It's easy to do some one-off deals. It's easy to kind of do that on a local basis. It's hard to scale it. Your margins get squeezed. Data's not always there, whatever. But yeah, the landscape has drastically changed. Companies like mine that had, and it's not just us, but companies like mine that had focused on a more sustainable model, a tried and true model, revenue share, kind of turn that whole thing on its head. Instead of the majority of the upside going to the short-term rental operator, we give that to the real estate company. So it means that they kind of ride along with us. The downside of that is they get variable payouts per month. The upshot of that is when it's going great, they're seeing great rent premiums. And then in terms of sustainability for us, we were able to weather this thing. We were transparent and communicated well with our clients, and really didn't lose any, surprisingly, through this whole ordeal. And thankfully, demand was there after a couple of months of a downturn. So it is vastly different. We've changed in different ways, but it's still going strong, in my opinion.
Yeah, it's interesting you talk about the evolution of the landscape. So the investor sentiment is on this particular topic. So Michael, how would you go about defining flex rental?
Yeah, just kind of echoing some of Mickey's comments. It is, the flex rental master lease arbitrage space is a very high fixed cost business. Over 50% of revenues paid out as rent to your landlord partners. So, any sustained drop in revenue, like what happened with COVID, it really turns your model on your head. It turns the model on its head, and that doesn't account for the payback period for the furniture and everything else. And coupled with, it's easy to focus on one market, but real estate fundamentally is still a very local game. And having to recreate a new platform for every different market is very, very difficult. And that's why you saw you're seeing a lot of the contraction in the space with, with Stay Alfred and everyone else. From an investment point of view, we like the space still. I think it's, we're still deploying capital opportunistically, but it really is, companies that are very vertically focused on a market that we think that still has growth opportunities, like traditional vacation rental markets, and you're seeing a lot of growth with that here in the U.S. I think that's still very, very interesting to us, and where there's more of a technology angle versus just a real estate angle, also very, very, very interesting. And you overlay that with Airbnb's upcoming IPO. They did a capital raise with during the depths of the crisis, and you saw that with Expedia as well. So I think capital's still in the space. People still want to invest, but these last 4 or 5 months have been an interesting time, and I think some of the weaker players have fallen off, and as supply has contracted, demand has come back. You're going to see a lot more activity.
And Steve, from a UK perspective, we were talking about this yesterday, but do you think there is sort of a misunderstanding or a lack of understanding of what flex accommodation actually entails?
Yeah, well, I had to Google it to make sure I was getting it from the right angle. To be honest, when I ran hotels, particularly the budget hotels, and having come from hostels, I wanted to yield more out the rooms I had. So the top floor, we actually put foldable bunk beds in to allow for group accommodation through the summer and flat beds for corporates or families through the winter. That's how I saw flex accommodation. I think the story of COVID is, I was at UC Berkeley with 150 students going to come over for an internship program this summer. On the first week of March, Berkeley's campus shut down whilst we were there, and then Trump did his CDC speech. And we went from 100% occupancy of 200 apartments to 10% occupancy in a week, and with no hope of that market coming back. Fortunately, our apartments are residential apartments in blocks that we have control over, and therefore we're able to longer let those apartments. And as of today, we are actually full, which is quite amazing, at a lower rate that we were able to normally do. And speaking to landlords who explain, look, we can't yield like we used to because that market isn't there, but we have got revenue. And I think we've been able to show that we have a more flexible model around our apartments, that we can use it for different markets. And obviously Michael was talking about, particular niches of vacation or whatever. Was actually, I realized that London, hotels are running between 8 and 20% occupancy, vacation and corporate and group and youth, it's all gone. So actually, what else can you do? And what we have found is that with our style of apartments and our luxury brand, the residents have actually done pretty well throughout. We've been quite lucky with that. Is that flexibility to switch on different models and different markets at different times of the year is really important. And although we have the technology property management system, we also have the knowledge and the ability to pivot quickly because we're only in one city, and that does help us with that local knowledge.
We've already touched a little bit on the Airbnb IPO, but Susan, I wanted to kind of branch out away beyond just the flex rental concept. But what gives you optimism for the flex rental and the short-term rental market based on this?
I think what's important to remember or recognize is that operating systems are agnostic as to whether you stay a day, a week, a month, or a year. They're indifferent. And so technology has allowed these operating systems, all of these individual short-term rental, flex space operators, to manage their assets and manage their inventory in a way so that they can actually, just like an airplane, decide, or airplane pre-COVID, decide how much does it cost depending on when you buy the ticket, how much does it cost depending on when you book the room, or when you book the apartment. And because of that indifference as to the length of stay, there's really the ability to goose these NOIs on these buildings. And that's certainly what we've seen with Airbnb. I mean, the biggest number I've seen is 40 billion for their IPO. That's a huge number. They're back in the 60s operating, 60% operating. A lot of it is being driven by families. A lot of it is being driven by personal stay, not professional stay. I think it's going to be important, and it'd be interesting to hear what Steve and Mickey and Michael had to say about this, but it's going to be important for the long-term health of this short-term rental space. Two things. One, the master lease is dead. It was dead before it even got incorporated for obvious reasons. One, it's a drag on debt on balance sheets. And two, it was an inducement to get people to it was an inducement for building owners to engage in an activity they didn't believe in, saying, well, if I'm wrong, you still get the same rent, so what do you care? So I think it's much more aligned now that it's a management agreement. The second thing is, for the long-term viability of this space, we're going to have to attract business travelers on a regular basis once there is business travel again.
And how does Airbnb's willingness to go public now, how does that show a sign of its strength, of the market strength, and particularly as it moves away from more of the urban inventory towards this traditional vacation rental market?
Well, I think it's important to have one big differentiator here. Airbnb is built on individual unit owners or homeowners using their space flexibly to make money for themselves. Airbnb is not driven a lot by institutional players or institutional blocks. And so that part of it, they've been very successful with and smart about, particularly in terms of their refund policy that they struggled with, but they got their act together in May and June and started backing up some of their individual hosts. But that's a completely different model than something that Mickey and Steven are doing. And I don't know, Michael, what your investment strategies look like. But there is a big difference between an individual homeowner renting out his or her home, and institutions jumping in and saying, I want 200 units in this building, and I'm going to flex it up and down depending on demand.
That leads on perfectly to my next question, because that was going to be directed at Michael. But why, Michael, do you like the investment in unique and alternative accommodation? And how do you see that affecting the likes of Domio, who you've invested in, Sonder, these other businesses, and how they can grow now?
Yeah, no, that's a great question. Well, I think from a macro level, from a sector level, we like the vacation rental space. We think that group travel will be a continuing trend, a macro trend that will outlast COVID. It's just a different way of traveling. Millennials, families want to stay together in an apartment hotel, in an apartment. They don't want, stay in 3 different hotel rooms on 3 different floors. And I think a lot of that, there was a pause of that in COVID, but I think those trends will continue to accelerate. And we're seeing that in our portfolio in Philadelphia. Even though, for example, the University of Pennsylvania has canceled basically fall instruction, we still see a lot of families come and move in their children into multifamily apartments. Actually, they will actually rent out the Airbnb, our apartments for 3 months, because their kids don't want to stay home and they still need to go to school. So they want a comfortable place where maybe 2 siblings can stay together, has good internet, in a safe building. So I think that is still definitely there. And, kind of looking back to your question about why we continue to invest in this space, we think that there's a big technology angle here that the traditional hotel companies aren't going to be able to hit. They aren't going to be able to flex their space in this way. So I slightly disagree with the master lease model is dead. I do think that there is a hybrid there that, if you can guarantee a certain amount of rent and some upside, I think there is a model there that may work depending on the market, depending on the supply of the market. But also from a technology angle, we do think that, it is scalable, particularly if you're looking at just pricing or a PMS system versus, a purely master lease model, like a Stay Alfred, that's grown, that grew very, very rapidly over 3 years, multiple markets, and we've kind of seen the results of that. So.
And you've got the likes of Domio and Sonder now who are starting to pivot away from the master lease model. So
Exactly. And on that point, though, I do think, if you speak with, and, as you said, we're investors in Domio. So, I'll kind of keep my comments high level, but, I think there is a price of admission into this industry where you can demonstrate that your management model works with short-term rentals or with inventory, and sometimes you have to kind of buy that inventory first, demonstrate that, build that brand, build those systems, and then you're able to leverage that out. And I think that's what Domio has started to transition to, and with some success. And we'll see kind of how that goes. Sonder still is very much the apartment rental model. I don't think they've pivoted as much. And then you've seen some of the other players obviously kind of fallen off and go into bankruptcy. So again, we'll kind of see how it goes. We're bullish that the Domio model can be successful, and the Sonder model can be successful if done properly.
I realise we've already touched on pivoting and towards extended stays away from the master lease, but Mickey, I'm interested to get your opinion on how you yourself are reducing costs at Vector Travel but still managing to differentiate and innovate your product. Is it?
Yeah, well, I mean, one of the ways that we innovated during COVID, just like many other operators, was to finally open up to those midterm stays. So of course, we knew the corporate housing model. I met peers from your organization, right, at a corporate housing event years ago. So I'd connected the dots, but it was more around specializing, adding that value as that to follow up on some of Michael's comments. This management model in the multifamily space, it couldn't have happened unless the corporate leases, the master leases had occurred first. That paved the way, helped the chasm crossing begin. And then, I was somebody who already had some relationships, so there was some level of trust there. And then it was a matter of building trust around what we're doing at Vector, not just me as an individual. And and thankfully we've executed in general for our clients. But yeah, opening up to those longer term stays, yes, it's as simple as a few clicks of a mouse on your OTAs, but there's a lot more that goes into it operationally, and to ensure that you do it well over time. And you're kind of opening up to where traditionally maybe your clients did some shorter term leases, maybe a 3-month lease. That's where we cap it. So, how do we be a good partner and not cannibalize on what they're doing? How do we vet guests? Traditionally, if you're thinking about a hotel sort of booking, almost no vetting, right? It's just, does the credit card, does the charge go through? Okay, cool. Did they show up? Great, they get the room. If not, we keep the funds. We've had to do more in the way of guest screening. We've seen COVID parties and those sorts of things. It has not been easy, but we've managed to keep occupancy really high. So, really, we had one blip. We had April that was bad. We were down 40%, but only 40%. You heard some of the hotel comments from Steve. So since then, ADRs have been lower than we wanted, but we've managed to keep occupancy up. And part of that is with those midterm stays, and thankfully Airbnb had invested in that. They bought Urban Door. They'd really kind of laid that infrastructure. They were poised for that. We saw, percentage of bookings go from a minority that were Airbnb to, around 50% or something all of a sudden. So that was great to see that we were well positioned for that. Then otherwise, I took a road trip recently with my family, and we stayed in hotels because we were there one night at a time. It wasn't the perfect fit for short-term rentals, and we were in some kind of off the beaten path places in middle America. But we stayed in hotels. I couldn't believe I had to go into a lobby. I had to stand in line with people. I had to get a physical card. I had to swipe my credit card. I did not feel good about that whole experience. And then when you contrast that with what I know we're doing, right, which is pretty typical for companies like Domio and ours, self-check-in, going in.
We seem to have lost Mickey's sound. Can you still hear us, Mickey? Okay, I'm not too sure. We'll try and get Mickey back. Steve, I might as well just continue with the question there. But how much of it do you think comes down to simplicity and understanding when, and making sure that nothing is wasted when it comes to your operating costs?
Yeah, I mean, I think we, when I became CEO a couple of years ago, we used to have a central check-in point. We used to then pay for cabs to take people to those apartment buildings. We did the hotel check-in centrally. And then basically as of last year, we did self-check-in. We actually developed our own self-check-in system, which includes a passport scanning and ID scanning system, which is really important from the COVID party, but also chargeback with credit cards to make sure that we had the right people doing that. Because once you've taken away that personal contact, the COVID party or the party apartments that become a lot easier. And we have had, unfortunately, some pretty dramatic parties, one involving a police helicopter coming over one of our buildings. It's amazing how many people you can fit into a 2-bedroom apartment. But that was an issue, and that's when you take away that personal contact, it's a problem. We do far more vigorous pre-arrival checks. So again, the more we don't need people called out in the middle of the night, the better it is from an efficiency point of view. And it was really looking at what is in the apartment of what people really use. So one of the things with the residents, it's a luxury brand. We do a lovely welcome pack, and what we started to do is actually monitoring what people were actually using in their welcome pack. We put health bars, we put all of that stuff. We did another one, which was half bottle of champagne, crisps, sweets, all the naughty stuff, all went. Health bars were always left to the side. The reality is, if you traveled a long way, you probably want to treat yourself. And then it was trying to keep things to necessity. You know, same with linen, same with towel drops. Through COVID, we couldn't clean the flats, but we provided linen drops. We actually asked people what they needed as opposed to just doing a standard pack. And that has just made us more efficient throughout that process. But I think it's probably my background in budget hotels. The whole budget hotel model is trying to keep things minimal. And a lot of budget hotel brands, it's minimal and minimal service. What we want to provide is a full service, but minimal fiddly bits, if you know what I mean, to make sure it's as efficient as possible.
Talking about your residences and your educational centres, what sort of trends are you now seeing where developments perhaps are changing to more mixed use and those flexible models?
Yeah, so our budget, apartments for students, we now are renting out for 6 to 12 months on a more mainstream model, whilst mixing it in with some shorter lets. And we're getting everyone from young professionals to students, international students. What is interesting is the traditional dorm model or the PBSA model, where there's big communal space. Actually, although the students want it at this moment in time, this very moment, they quite like their own little cocoon, particularly if studies have to go online. They want to have their own personal space. They can study, they can live, they can work. Internet being more important than hot water most of the time. And then from the resident side, where we're a corporate perspective, is most of the requests now is, I want a desk. The internet has to be of a certain speed, that really prescriptive amounts to make sure that person can really work from that apartment. The student wants a study desk, the corporate wants a work desk. All in all, it's all very similar in terms of that, using that apartment space for more than just sleeping in. And it's actually living in, whether it's for a week, a month, or a year. And I think that's what has been very interesting. And even through the whole period of time, we've had a really big increase in pets. So the most unusual has been a snake. Do you accept snakes? Yes, okay. Anything to sell a flat. Obviously dogs and cats, but also outside space. So the terrace for a corporate stay now, 70 to 90 days, is a premium. People are really looking into, I'm requesting outside space, which is great because we have quite a few apartments with balconies, but that's something new that we've seen and is understandable because, again, if there's a second lockdown, which we touch wood hope doesn't happen in London, then actually having that outside space is even more important because we all want to be out and about, even if we can't. So that has been a trend we have noticed. And even at the budget level, more people asking for the square footage or live video calls of the flat, not sending them a promotional video, actually someone going in and FaceTiming around that apartment so they can see what they're getting into, which is a new thing, whereas people used to, you know, this is again for longer stays, but it's something that we've accommodated all the way through since March, and has allowed us to convert probably better because we've been there and active. I think there's a trust side of it that's important.
Just a reminder to everyone that if you've got a question for our panel, please do post it in the chat. I see there's a few comments already coming through, which is great. Michael, I wanted to ask you the next question. We're talking about asset types and locations which create most value for owners, and I think you're the perfect guy for this. I guess with fewer people maybe chasing investment now within the space because of the likes of Lyric and Stay Alfred sort of winding down operations, what do you see opportunities for value in 2020 and 2021?
That's a good question. I'll kind of divide the comments between from a kind of an asset point of view and then kind of from an operating point of view. From an asset wise, look, anything in a traditional vacation market within 2 hours of a major city, those assets are white hot. So, you know, I'm based here in New York. Anything out in the Poconos to up in the Hudson Valley, east to the Hamptons, you know, it's very, very tight inventory, both from a, you know, if you want to buy units or just, you know, rent out the short-term rentals. The supply is very, very limited. Prices, ADRs, RevPARs have gone through the roof. So, you know, we're continuing to invest there. From a company perspective, we're probably on pause to see kind of how the winter shakes out, just given, I think there's a lot of uncertainty in the market. The range of possibilities is pretty broad. The number of inquiries we've gotten have really kind of slowed down, just given, you know, if you're going to do a down round, or you're going to probably go back to your existing investors, and you know, kind of anything else is going to be a pretty tough slog in this environment. But look, we still really like you know, anything that's more software focused. So, you know, anything around pricing, we like. Anything around continue to optimize for costs, we'd really like. Anything around IoT, right? So anything around locks, anything around locks or noise sensors, things like that, where there's a real technology angle. You know, we think that there's still opportunities, and valuations have come down. So, you know, that's where we think the opportunities in 2021 will go. But I think really over the next 3 months, it's going to be very, very interesting to see, you know, if there is a second wave, how the governments react to that. You know, how we look at things from a medical perspective. If you know, if there is a real vaccine, you know, how long does that take to scale up, distribute, test? So there again, you know, kind of a very broad range of possibilities. So, but we think that, again, back to my earlier comment, you know, this is a secular trend. People are going to continue to travel in large groups. Travel's existed for 5,000 years. There've been plenty of pandemics in the interim of that. So this isn't going to change.
And Mickey, another of the players that we've seen kind of winding down business has been the Expedia multifamily business, which I'm sure you're aware of. How do you think these real estate spaces can be capitalising on the needs and opportunities within the market now with this downturn?
Yeah, well, and that's actually how we do things, by the way, in terms of our business development. We don't whiteboard markets we want to be in because we really can't. We can't just go throw money at leases. We have to find partners around this. And so somewhat we can be analytical. We can look at vacancy needs. And so we've positioned ourselves again within this apartment industry, the multifamily industry. And there's really, there's a few different subsectors within that, but the two that we focus on are student housing and then conventional, market rate properties. And so we've laid that foundation for over a year now to kind of help where there's a vacancy need. And like Michael said, some of the university housing that's off-campus private housing is at 100%, even if the school is closed, because of the uncertainty, because these are young adults, they want to have their own spaces oftentimes, and and yet it's a totally different story in other markets. And so we're well positioned around that, and we're signing new clients and growing there. And then otherwise, it's we come in a stabilized or a lease up scenario, and there's a perception, I think, around an unwillingness to commit for some consumers right now. And I think, we don't have great data on that. We are seeing things like, the apartment data, rent collections are actually surprisingly still very high. We thought maybe we'd see more vacancy come from that, but I do think their rents are not necessarily escalating like they were, and in some cases they're on the decline. And so we can come in and we can facilitate that. We can drive up the return on any given unit, and then, again, we can activate the vacant spaces. So.
And talking about vacant spaces, we're seeing sort of this shift now towards more remote working, and that poses the question of trends within for digital nomads. So Susan, I direct this question at you because your own CEO, Brett White, I believe, said that the size of a remote workforce may have doubled since the start of the COVID pandemic. So who do you think are going to be the beneficiaries of these digital nomad trends and shifts that we're seeing?
Here's what I would say about that. It is very important to work from home right now for social distancing and for public health. I think over the long term, we will see a shift in working from home to 2 days a week. I don't see a shift of working from home regularly, meaning full time, after this thing passes. You don't get promoted working from home. You don't have a sense of culture working from home. You don't have camaraderie working from home. I know before this call started, Mickey was talking about, he's always been remote, but he's always traveled. He's always been face-to-face somehow with his team. And I think that we're going to see a return to the office space. However, when you do want to work from home, that's going to be a very acceptable format, and that means that you can live anywhere you want to within distance of being able to get to the office. And so I think that parts of the things that we've seen that Michael alluded to of short-term rental for long periods of time, 90 days, 120 days, I think we'll see that number come down over time, that length of stay. But I also think that that means that you can live 3 months in Austin, 3 months in Denver, 3 months in San Francisco, as you figure out where do you want to call home and how old are you before you put roots down. So I guess succinctly, an answer to your question is, I think work from home is here to stay, and I think there's some benefit to that for short-term rental or flexible space, but I would hesitate to over-exaggerate the long-term 100% work from home. I'm not riding that bus. I don't believe in it.
It's interesting because we quoted some statistics from the B2C marketplace, Anyplace, last week. And it was that the average length of stay for US digital nomads on its platform is now 7 months. And these digital nomads were moving away from New York, San Francisco. Steve, what are you seeing in London at the moment?
Well, I think London, is a collection of 31 little villages that have morphed into this big city, each with its own identity in each area. And I think over the last decade, the demand has shifted from west to east. What has been interesting is that that demand has increased through this whole period, because people want that local community feel. As Susan was saying, people want the camaraderie, they want to see people, they want to be part of something, even if they're working from home. And actually the vibe of Shoreditch with the street markets and the food markets, they want stuff going on. It doesn't have to be nightlife for there still to be an atmosphere, or even be able to walk or cycle or see things, where some parts of West London have got less demand for that now, because they have almost homogenized so much to be a tourist space that there are no locals and there's no vibe. And I think that's something that's really, really important. I do think my wife actually did her master's thesis on flexible working, and she's based in London and New York. And it was very interesting, the attitudes of working from home between London and New York in terms of the two cities, particularly from an academic perspective. And I think we'll be flexible. I think there are people who commute, particularly to London and big cities like New York, for a long way. So actually having 2 days from home, not only will it save them money, it will probably give them a little more energy. But I also agree with the fact that you need that interaction. We have some corporates who are booking with us, big tech companies, and their request is to be walking distance from their office, even though the public statements are that they're working from home. It's they can work from home, but if they do wish to work from the office, they can. And you will have people who prefer, particularly if you're doing a technology sprint, that may want to be in a room socially distanced to get through it because it's easier than Zoom or people cutting out because the internet's gone down. Obviously not in our apartments, but you know, other apartments. But you don't get that with being face to face. And I think that has been the shift, and people wanting to know what's around the apartment and what's going on, and you know exactly the postcode so they can see what is happening. And I think that will only increase, and that works for cities, but also rural areas that people may bunker down for 3 to 6 months with a real vibe. And this is not new. I was doing a charity project in Cambodia, in Siem Reap in 2011, helping run a guest house there and training all the staff. And one of the guests in the thing was a French developer, software developer, who was a digital nomad. And I was like, what are you doing? He goes, I'm working. I said, I don't understand. He's like, yeah, I'm working from here. So why did you choose Siem Reap? Best free internet in Southeast Asia. I was like, okay. And that was that's all he wanted. So we're cheap to stay and cheap free internet. And so that's evolved to different things, but I think community feeling, if people have to work from home, will be very important.
And on that basis, what types of flex rental operators do we think are best positioned to be coming out on top or taking their market share? So, Susan, do you think this is about differentiation, innovation, pivoting? What would be your priorities, the sort of companies that are best?
So here's what I think. I think that flexible space, short-term rental is here to stay. I don't think that building owners are going to give up the VIG, the change in income, by being able to flex this space up and get the extra rent, whether it's a day, a week, or a month. I think that the operators are going to start to differentiate themselves. I think keyless entries, I think checking in remotely, I think remote leasing, people wanting to see, all of that stuff is accelerated. It's all been here for the last 10 years. It's not new that you have a keyless entry or a keyless lock, but what is new is the public's acceptance of these kinds of check-ins, scanning your passport, doing your finger ID to release the key if there is a key or access. All of those things now are here to stay, and they're cemented into the multifamily space. It's going to be interesting to see as operators who attracts institutional attention, because Greystar, Lincoln, Bozzuto, Pinnacle, the big operators are not going to sit on the sidelines and let this money go to someone else. And so I would say that we're going to see some big national operator try and buy one of you guys, because they're going to jump the shark. They want to buy time.
And same question to you, Steve. What do you think is most key when it comes to navigating?
Well, I think it's flexibility, and I think the technology stack, I think now is so accessible for everyone. I don't think it's as unique as sometimes it's made out. I think it's quite easy to do a lot of the stuff, and we developed our kit for the same price that a software provider was trying to rent to us we'd paid for it in a year, so you might as well do it yourself. It's accessible. I think that's important, but I think it's that flexibility, and some brands are too stuck in the ways in terms of the lifestyle and some brands were all about lifestyle and social interaction, and for 3 months no one was allowed to socially interact. So why are you going to pay a premium for that? So it's having that flexibility in the brand to be able to manipulate things to changing times, and hopefully, as Michael said, by next year, where there's hopefully a rebound in terms of people's pent-up demand for travel, that they can shift again to shorter stays and better service, even if that service is via digital platforms. So I think that flexibility, although a lot of investors like to fixate on a very defined market mix, I think apartments will have a much wider market appetite, because people will appreciate that sort of personal space, and I think those people who can flex it will be able to really adapt and also be open to opportunities that others will be too fixated on and fitting into their brand.
And I'm going to give the last word to Mickey just before we go to Q&A. So we were talking before about something Simon Lehman from AJL Consulting said, that there's going to be those that focus more on profitability over revenue and rapid growth are going to be those best positioned. Is that something you go along with?
It is, yeah. So again, given that context, it starts with the model, and then applying that model and executing it well, and but then it comes into optimization of that model, and so making sure that you're delivering on a repeatable basis great guest experiences so that they come back, so that your reviews are great. And it all starts there, and then it flows to your clients. Are they performing well, especially relative to what the alternate use of that unit or that asset is? And then and then it comes ultimately to the operator. And by the way, that is how I view what we do, is as an operator. I mean, we even white label our services for clients. So in our experience, it's not that easy. I mean, it's a lot of work every single week. We're focusing on getting incrementally better, 1% better or whatever. And then we're constantly looking to innovate, integrate new technology, find a new channel to list on, look at how we're servicing our guests and clients and things. And so, yeah, I mean, I think that profitability does matter. It just also has to be within the context of the values, and why does your model get adopted in the first place? And so for us, it's a client-driven business, and so we have to ensure that we're not just charging $1,000 cleaning fee because we get to keep the cleaning fees, right? That's not going to serve us well in the long run, because it's not going to serve our clients well, nor the guests. But as long as we sort of balance those things, I think the future is bright for us and for other operators that have embraced this model or pivoted to it in this downturn, because it's a really large space. It's not necessarily winner take all, and that's evidenced by some companies doing it in-house, some companies sort of outsourcing, white labeling, whatever, and then others maybe taking some other version of that, like Michael was advocating, maybe a percentage lease and a fixed rent model, kind of on the same property. So yeah, it's interesting, it's battered, it's different, but it's we're all innovators if we're doing this, and we'll continue to do that.
I've got time to squeeze in a couple of questions. We've had quite a few through, which is really good. We had one from Guy Westlake of Lavender, and he's asking, he'd like to know where the term flex rentals comes from. Is that actually a thing? Susan, would you like to come in on that?
I think flex rental is a much more user-friendly institutional term for short-term rental. So flex is just, it feels better at investment committee than short-term rental.
So it's a euphemism.
I like that. We also had one from Paul Samuda, and he's asking, what are the main tech developments that are trending with this flex rental concept that actually adds value to the operator? Michael, is that something that you'd like to answer?
Sure, happy to take that. Look, I think right now, if you don't have, I'll just focus on kind of the key aspect. If you don't have, keyless, you don't have keyless entry where you have unique codes for every single guest, you know, it's gonna be tough to operate the business if you aren't diligencing your guests appropriately using internal systems or a technology solution. You're not going to be long-term successful because your landlord, your clients, whether they be the owners of the apartment or the owners of the building, are not going to allow COVID parties that disturb their other residences. And frankly, your guests are not going to want to come in to, if they can't access that apartment remotely, they're going to be disinclined to book. And and I'd be remiss not to say, but cleaning, really being really tight on your cleaning partners, making sure that, you check everything 3 times. It's because, frankly, if they see that errant hair in the shower, before that may have dismissed it, but now it tells them that this apartment may give them a disease, and that's going to be really bad for that operator. So I think I want to just touch on Susan's point about these larger property managers being interested in short-term operators. They're not going to let the profits flow to other parties. It's their properties. This is really their business. So I think that's the M&A opportunity, right? It's not just the Marriotts and Hiltons of the world, but it is the Bozzutos and the Greystars. Greystar did a $400 million deal right in the depths of the crisis, right? So, these guys are looking to move, and I think that's why, we're all on this call, because we think that there's real opportunity in this space.
I think to Michael's point about the biggest thing that all of these operating systems are based on is keyless entry. And it's not, the keyless entry is important for monitoring. The most important thing it does is provide security. Your key doesn't work before 3 on Friday, and by 2 on Sunday, you cut it off, it doesn't work again. And that single part of technology is what's going to allow short-term stay rentals, flexible stays to continue to perform and operate here. On top of the fact that now you don't have any lockouts. So you don't have to worry about finding somebody a key at 2 a.m. and that cuts down on your operating costs. But this keyless entry is the single number one, in my opinion, technology adaptation that makes this asset class work.
I'm just going to try and squeeze one more question in. We've had a question through from Vlad Karakesh. He says that one of the things that Simon Lehman mentioned is that in the short-term rentals, the variable portion of the reservation cost can make up to 70%. Mickey, is that something you're concerned with? Just briefly, whilst we've got a few minutes left.
No. I may be misunderstanding something about it, but I mean, we can first and foremost, OTAs, their fees are a cost of doing business, and so everything we're running is sort of net of platform fees. And then we flex those up and down on certain channels for optimization purposes, and if that's what they're getting at, and maybe they're talking about reservationists and things, we don't do that. It's all instant book. I mean, we have guest service staff, don't get me wrong, but anyway, it's mostly automated.
Well, thank you very much to all of our panelists, to Mickey, to Steve, to Michael, and to Susan. Fantastic insights there. I'm just going to give you a bit of an overview of what's coming next. So next week's Urban Living webinar is on the Anyplace Workplace, the office of tomorrow versus the office of yesterday. So that looks like a fascinating discussion, and I believe the details are already in the chat there for you. This is a catalyst for 2 other webinar series that we've launched and we're coming up in the coming weeks. On short-term rentals, we've launched the Rockstars webinar series. That's with me, starting on September the 15th on Humanity v Technology. And then my colleague Eloise, who's launched Trailblazers for one of our other websites, that's Boutique Hotel News. So be sure to check them out. I know Eloise's is starting next week, and please register on the links provided or on the website separately. This is a little snapshot of what to expect at the Urban Living Festival in November. It's an in-person event taking place in London. These are some of the fantastic exhibitors and also our festival sponsors coming up. And then beyond that, yes, very glad to have them all on board. Thank you very much for your support, and our media partners as well. I can't forget. We're really grateful for all of their support during these times. And for sponsorship opportunities, please do get in touch with my esteemed colleague Katie. Details are on the screen now. So here's a list of all the webinars coming up. So as we already mentioned, the Anyplace Workplace webinar coming up next Wednesday. So all that leaves me to say is thank you again for listening, and to all of our speakers, thank you again. And we'll see you next time.
Thank you, Paul.